All right. Hi, everybody. Thanks so much for joining today. My name is Britta Schillingsberg, and I am a marketing manager at staffing and recruiting firm Motion Recruitment, the founder and sponsor of Tech in Motion Events, our international event series. For those of you who might be new to Tech in Motion, it is a community-driven event series with the goal of bringing tech communities together to share ideas and inspire one another. And today's topic is one that we find incredibly timely and important. As we navigate an evolving market and an uncertain climate, we here at Tech in Motion thought it was a good time to host a discussion around innovations in technology that have emerged out of necessity and uncover the unique challenges that entrepreneurs, founders, and startups might be facing right now. And for a unique perspective, we've selected members from the venture capitalist and angel investor community to share with us what they're seeing from startups, what investment trends are emerging, and what they're looking for in a resilient company. And one last note, definitely stay tuned at the end of our webinar for an exciting announcement for all of you who joined today. You definitely won't want to miss it. So a few housekeeping items real quick before I kick things over to our moderator. First, you'll all notice that you have joined this webinar in listen-only mode, so feel free to submit questions and comments in the chat box in your GoToWebinar panel, and we'll do our best to address those questions during the Q&A session at the end. And also, today's webinar will be available on demand after the live session ends, and you'll receive a live link. You'll receive a link via email to view the video after the webinar. So, with all of that, I'm going to go ahead now and introduce our moderator for today, Anastasia Simon. Anastasia is an experienced content marketer and startup advisor with a passion for storytelling. Before joining the Shadow Ventures team as the managing director of Shadow Labs, where she advises and develops programming for over 60 early stage startups, she leaned into her passion for storytelling and an obsession with emerging tech as a means for connecting brands and consumers. She also worked and led fashion and lifestyle brands on multi-channel influencer campaigns designed to drive awareness around specific products and experiences. So with that, Anastasia, I will go ahead and turn it over to you to take it away.
All right, thanks, Britta. So as she mentioned, I am the managing director of Shadow Labs by Shadow Ventures. Prior to that, my experience was all in marketing. I mean, everything she just said, fancy ways to say she's a marketer by trade. And I've kind of lent that experience to the startups that we work with. About 60 startups right now are in our virtual incubator that we've been running for the past 2 years. So I'm gonna kind of introduce our different panelists right now so we can get started, and I'm just give it over to you all for you to introduce yourselves. So first we have Ben Novak. So Ben, if you can introduce yourself.
Sure. Thank you so much, Anastasia. Britt, thank you so much for inviting me to join you guys here today. Really excited to talk to you. So I'm an active angel investor. I invest primarily in seed stage technology companies based primarily on the East Coast of the US, with most of my investing being in the Mid-Atlantic region, which I define as Boston to DC, Pittsburgh to the ocean. I do a lot of my deals through an active angel group in the Mid-Atlantic region called Delaware Crossing Investor Group. Personally, I look at close to 1,000 deals a year and invest in about 5. Separate and apart from my role as an active angel investor deploying my own capital, I'm also a partner at a law firm called Morgan Lewis, where I represent tech companies and investors in tech companies like other angels, VCs, private equity funds, and some of the bigger banks.
Awesome, thank you. So up next we have Lucas Timberlake, FinTech Ventures Fund. So Lucas, introduce yourself.
Great, good afternoon. My name's Luke Timberlake and I'm a partner with FinTech Ventures. We're an early stage FinTech, as the name implies, investor, and we also focus on InsurTech. And for us, we really like B2B models and B2C models. And we prefer to invest outside of Silicon Valley, where we see most of the value, and of our 9 companies, all of them are based outside of there, and look forward to sharing some insights, not only about FinTech, but generally what we're seeing in the VC market today.
Awesome, thanks, Luke. And then we have one more panelist, Erica Van, who is having some technical difficulties. And Erica is an early stage investor at Charles River Ventures. So as soon as we can get her on, I'll have her kind of introduce herself.
Can you
but
right now?
Hello? Oh, okay. So I think you guys can hear me. There's just no video.
Yes, finally, we got you.
I apologize for that. At least we have video right now. But yeah, no, so I'll introduce myself. Hopefully I'll be able to pop up on screen. I apologize for this. But yeah, so my name is Erica. I'm an investor at CRV. We're a multi-stage firm, but really focus on early stage. We kind of have 3 separate teams that focus on 3 separate things. We have a consumer practice, we have a biotech and healthcare practice, and we also have an enterprise B2B practice. In terms of geography, we're really spread across the US, SF, Palo Alto, Boston, and New York, but we invest domestically as well as internationally. And myself, so I am personally on the early stage B2B team, and I specifically work with East Coast companies. So I'm on the #CRV East team, and that's kind of my focus here at the firm.
Awesome. So thanks, Erica, and so glad that you were able to, we can at least hear you for now, you know, like, that's the most important part. All right, so let's get this started. So to the panelists, from your perspective, how has COVID impacted the tech investing landscape? You guys can kind of
I'm happy to start. I think it's obviously impacted it, but the caveat that I give is I think it's perpetuated changes that were already in motion, whether you look at contactless payments, you know, healthcare, doing that virtually, and various other aspects such as Zoom and teleconferencing. So in my view, it's really just started to accelerate trends that have already been, you know, in the woodwork or coming out slowly over time. So that's kind of how I'll approach it in terms of no drastic change, just acceleration of change.
Sure, happy to jump on. So the COO of one of my New York-based tech companies that I work with, just as this was all starting, called me and said, "Hey, you know, everything that's going on right now, like, you know, is this impacting your practice?" And I said, "Absolutely." And she said, "How is it impacting your practice?" And I said, "I don't know yet." And I think each week I continue to reevaluate how this is impacting my portfolio companies, how this is impacting, you know, the other companies that I work with. You know, things have changed for sure, and how they've changed is complicated. I would say a lot of it is industry based. So some industries are blowing up right now. So, you know, deregulation in healthcare, for example, is creating a lot of opportunities for certain digital health solutions to really ramp up and scale when they were dealing with challenges prior to this. Certain other industries are doing incredibly well right now, but, you know, certain are doing horrible. You know, one of my portfolio companies is based on people being in a physical office that's not their home. That company's not doing very well right now when everyone is at home. So it's really a range of some that are doing much better, some that are doing much worse, a lot that are kind of in between and pivoting their models to kind of address the opportunities and deal with the challenges of this pandemic. So happy to kind of, over the course of our talk, go into some specific examples, but I would say everything has changed, and how it changes and how things have changed really depends on what you're doing.
Yeah, and to echo what Ben and Luke had said, totally everything they said resonates with what we're doing at CRV and what I'm doing with my companies. I think there were 2 kind of waves within COVID of how investors were reacting and how startups were reacting. I would say, you know, right when everyone was sheltering in place, and there was very much a panic type feeling in the market, we certainly at CRV went into defense mode. So what does that mean? That's you know, setting up as many meetings with our portfolio companies as we could to make sure that they felt supported. It was making sure that every company had 12 months of runway, whether or not it was equity, whether or not it was an extension, whether or not it was debt, and making sure that they were protected. We're very much in that defense mode. I think, I mean, startups pivot so fast, and obviously like the VC world pivots alongside, you know, and with our portfolio companies. I feel like we've now kind of entered this wave where you're starting to see people peeping out in terms of investing again, and people starting to recognize trends in companies that are positively impacted by COVID, that are neutrally impacted, and those are kind of struggling with it. And we definitely have seen this resurgence of investing. You know, I think that yeah, that's how I've seen the phases in terms of investing that have taken place. And we don't even know what's going to happen next, but investing has definitely seems to have picked up a little bit more.
Yeah. So with that, because I think one layer of it is, the current economic downturn. So how do you think this current crisis as a whole compares to previous economic downturns? I know, like for me, I started my career during the last economic downturn, so I kind of would love to hear your insight as well from some of you who may have been in your career or who may have been in investing at that point.
Yeah, I'd say it's more, again, not to use the word acceleration too many times, but I think things shut down pretty quickly and then started to pick up very quickly, and they may shut down again. And so I think the pace of all of the changes is more rapid than, other sorts of recessions or periods of downturn in the stock market, however you want to measure things. And the stock market's not reacting, I think, to the state of the world as well. So I think there's a lot more kind of pace of motion in both directions is how I characterize this versus others. And, we're still only 3-4 months into it, even though it seems like years at this point. And, I just say everything's going to change very quickly either way, and kind of leave it as that as kind of the open statement for now, and, kind of turn it over to everyone else to expand on that, because I think they'd agree, but may have different nuances to add on that point.
I'll just add that I feel like the uncertainty now is that there's so much different types of uncertainty right now. So this isn't just, the market is down. This isn't just a financial collapse. This isn't just a recession. This is a pandemic. This is, people are fearing for their lives and the lives of their loved ones. People are, afraid to leave their houses, which is, just a totally different world than we've seen in other recent economic downturns. And all of that uncertainty is just creating a lot of risk, and people don't know what's next. So in any economic downturn, most investors say, well, the market's cyclical. Okay, the market's down. We're entering into a recession. This is my strategy during the recession, and then this is when I anticipate a recovery, or this is what I think, when the recovery might come, and how I'm gonna, prepare myself for this type of, economic state. Here, I think there's just so much uncertainty that people don't know what's going to happen tomorrow. People don't know why the stocks are being held up. People don't know a lot of things. And that's just resulting in a lot of different things happening kind of in different industries and different companies to try to address what's going on right now and different predictions as to what the future will hold.
Yeah, and I won't try and repeat anything that was said before, but I mean, the state that we're in today is very much like a black swan event, right? So, you can look at as much data as you want, and you can kind of build models to forecast what you think will happen, but it's very difficult to predict anything that's going to be in the next month or 2 months or 6 months. And I think that's certainly led to a lot of confusion and frustration from everyone on all parts, startups, big companies, kind of investors. But it's just the state of the world. There's nothing that you can really do about it. But just with the hope that things will get better, obviously.
Right. And so knowing that this is where we are, how have the parameters of what you're looking for in investments changed?
So I think, one thing that's interesting right now is we're in the summer periods where people aren't really, generally speaking, looking at new deals. And so I think really the fall is going to be the litmus test as to whether things are back to normal. And then we'll see certain data on everything that's going on in terms of whether schools, universities are in person or not, because that does affect productivity. And so for us, it's wait and see, although we did 3 deals year to date, but I think the one difference in terms of how we approach things is we preferred to price rounds, but 2 of the 3 deals were, different structures than we considered before. And so I think it's being flexible and having some sort of optionality in terms of how you approach the world is still going to be the norm, even going into the fall when we have more certainty, and people are going to start fundraising again, at least in my view. So from our business, that's kind of how I view it, is a little bit of wait and see right now, since we're in the summer and things tend to slow down. But looking towards the fall and trying to see that and using that as a litmus test is what we're going to be doing in terms of the new normal going forward, end of year and next year, when a lot of people think that there'll be a vaccine and some sort of recovery, at least by April kind of 2021 is the consensus I'm seeing, at least from VC and founder surveys at the latest.
Yeah, I mean, I think following on with that, so CRV has been through a few downturns. So we started 50 years ago, and actually our founder still comes into the office sometimes, and especially during when COVID started hitting, we kept asking him, what's going to happen? Like, what's going to happen after this? Like, what have you seen in the past that can help inform the way that we react to the situation today and help us prepare for the situation, tomorrow? And his take was really, it is always different. After every downturn, after every market change, there's no way to predict what's happening next. And CRB certainly has been through has gone through the motions and tried to, predict what would happen and correct for it, but it's always different every single time. And so with that in mind, we have been investing pretty much exactly the same. That's kind of been what we've been, been in our heads, and how we've been going out, searching for companies, hunting for companies, trying to partner with companies. And what it really comes down to for us is the team. So the CRV kind of mantra is very much investing in strong teams, more than revenue, more than traction. But if you invest in an incredible team, our philosophy is that they will weather the storm and kind of rise up above it. That being said, having worked with many of our companies through this, and even just talking to companies every single day, one thing that is very different is that every CFO has a spreadsheet open on their desktop all the time with every expense, every single expense, and they're going through it, and deeming things essential and deeming things non-essential. And when that that's happening in the background, I certainly have a lens in terms of because for me, since I spend most of my time with enterprise software, I'm always thinking, is this a vitamin or is this medicine? And what I am definitely trending towards more in obviously this weird world that we're in today is medicine, right? Because again, thinking about the CFO, thinking about every founding team, thinking about every person drilling down on that. So that's one thing that has changed, and one thing that I've definitely adjusted my lens for.
So to Erica's point about every CFO keeping the spreadsheet open of all the expenses, I was in a board meeting a couple of weeks ago, and one of the directors said to the CFO, "You're sitting on the till, you have a gun in your hand, and no money is going out." That was literally the instruction in terms of cutting costs and trying to preserve cash until there's some more certainty as to what's in store in the market for this company. I would say a lot of things are the same, right? So we're still at Delaware Crossing largely investing in the same types of companies. We're investing at the same stage, same size checks, same geography and so forth. But one thing I'll say two things that are changing. First thing that's changing is we are looking for companies that not just have a COVID plan, but are doing exceptionally well during COVID, but that's not enough. So we're not just looking at COVID response companies that are going to be doing well for the length of this pandemic, and then have a product that's largely irrelevant. So we're looking for technology companies that have something that's interesting now, going to do well during COVID, but also have a plan for post-COVID and have a product and a business that would survive and thrive post-COVID as well. That's the one thing that's different. We're not just looking for that, hockey stick growth where they're about to explode. We're saying, hey, how are you going to do well now? And then when things change again, how are you going to do well post-COVID? The other thing that's changing a little bit is we're particularly sensitive to smaller rounds. We do mostly seed investing, some pre-seed, but I'm concerned about any runway that's less than 12 to 18 months. So if a CEO is coming in and pitching a $500,000 million deal and that's their 6-month budget, I'm a little concerned that I don't know what the capital markets, what the VC market, what the angel world is going to look like in 6 months. And there's some concern that 6 months of capital is going to drop you off at a precarious place. Having 18 plus months worth of capital likely will kind of de-risk our investment a bit. So we are looking slightly at larger rounds, and I wouldn't say later stage rounds, but companies that are doing well now and in the future and raising an appropriate amount of capital for the company now to survive 18 months.
Yeah, and something I'd add on that, I think for us as early stage investors, historical financials, we always look at them, but they're not terribly important, but they've actually become more important. And I like to actually spend time with founders that we're looking at now to see how they cut their expenses and when they did and what they cut in terms of, optically salaries, for instance, if they can afford to do it to manage burn. And so we actually look now more at the historical performance during COVID, not on the revenue side and not on the revenue growth side, but on the cost management side, because I think that's a very good test of the founder's ability to get ahead of things or react to crises that are beyond their control. And, again, it is people and it is the ability to manage through crises, whether they're externally or internally kind of focused on the business. And I do think that's becoming more important, at least for us, where, pre-COVID, we were really looking at future potential as opposed to prior results.
Just to add on to that, so to echo Erica's comment about team, I like to think that I invest primarily in team. If I were to say the top 3 things I'm looking for in screening companies, I'm looking for a good team, a diverse team with varied experiences, 1 or more products in market, and some significant amount of traction, with the focus being on team. From the investor's perspective, one of the advantages, to Lucas's point here, is we have a lot of great recent data points on how the company is dealing with a whole bunch of shifts in the world. So, one of the key things that I look for in a team is, are they flexible? Are they coachable? Are they open to pivoting? Are they, receptive to putting something out there, getting data, and then revising their business model based on that data? And just so many things have been changing over the past few weeks and months. We have a great opportunity prior to investing in companies when we're in diligence to kind of see how they've been navigating. But to Lucas's point, we're also looking very closely at, how are they managing their burn? How have they changed things? How lean was their model before? How lean is their model now? But in addition to that, how are they pivoting the product? How are they pivoting who they're talking to? How are they pivoting staffing? There's a lot of changes going on right now, and seeing how they manage that is a great indicator of how they'll manage and deal with the next challenge.
For sure. So Ben, I want to kind of roll back to a point that you made earlier. You were talking about companies that are doing well, and markets that are doing well. So in your experience of the panel, as we move into talking about market and industry trends, what industries and sectors do you see that are experiencing the greatest demand or growth right now through this crisis?
So this is a fun one because I get to talk about my success stories, right? So, fortunately, I've been lucky to invest in a lot of, software SaaS solutions that do particularly well when people are working from home. So different technologies that are making it easier for people to communicate, different technologies that are making it easier for people to work from their home computer. Those, I'll call it the work from home sector is doing particularly well right now, and while they're dealing with some challenges like most companies now, they're also seeing increased demand, which also brings new challenges for a company as they start to have explosive growth that they weren't planning on, but generally a good problem to have. I mentioned digital health before, so I work with a number of telemedicine companies that are really rapidly scaling right now because there's a lot of investment in that space and increased investment in that space as people are trying to invest in companies that they think will be winners, but also companies that are doing good at a time of, pandemic, right? So the regulations, state by state that are coming down, especially in the US, are making it easier for those companies to launch. Previously there's a pretty high barrier to entry in that type of tech sector because of all the regulatory issues involved state by state. As those regulations have become more lax, it becomes easier for players to kind of get a foothold in the market and launch a product and really start rapidly deploying their solution. One other one I'll mention here, just because it's kind of humorous, and then I'll turn it over to my panelists to name some of these other industries on my list. But I invested in a fishing technology company not that long ago, and apparently now, with lots of people out of work and people working from home, fishing is way up. So that's something a little surprising that I thought was interesting, that company's doing well right now.
Yeah, and or Luke, did you want to go?
No, go ahead.
Yes, so similar to things that Ben had mentioned, telehealth and kind of tools for distributed teams and collaboration tools, we're certainly seeing an uptick in that. Other things that we've seen accelerated, to use Luke's term, is definitely kind of next gen retail and kind of e-commerce. So e-commerce was already on the rise, retail was, people were shifting their behaviors to buying things online, but the e-commerce world has just accelerated like we've never seen. Like it's taken leaps, leaps that are equivalent to years, just in the past couple months. So, one example of a next gen retail solution that we've backed is like Standard Cognition, which is another version of Amazon Go, where it's kind of touchless. You don't interact with anyone in the store. You're able to pick up something, kind of walk out without paying it. And so that touchless kind of retail experience is something that we think is interesting. Delivery is off the charts. So kind of third-party logistics providers, delivery, we see, it's interesting. So DoorDash, we were one of the first investors in DoorDash. And when we originally, COVID had hit, we didn't think people wanted people touching food, right? I would never think that you'd want people touching your food and then delivering it to you with the chance that you could catch it. But DoorDash is, the demand is off the roof. So that was a different thing for us that we didn't expect, but delivery is doing very well. We're certainly seeing a lot of interesting supply chain companies. So, supply chains have been strained across any, company today. And so companies that are dealing with transparency across supply chains, tracking, kind of being able to get real-time feedback on where items are when they've arrived at your destination. We're certainly looking at that space. And one that also is definitely, we expected it because it was a little obvious, but it's definitely taking us by surprise, is kind of identity management. So with more people working from home and people having their at-home devices, verifying identity as people go into systems and access sensitive databases or whatnot. We have an investment in a company called One Login, which is certainly very positively impacted by COVID. You see other companies, we weren't investors in Okta, but you can just see their numbers rising as well. So compliance, identity management, security, those have taken leaps and certainly have seen an increase in demand.
For us, I think there's three main areas that I'll touch on quickly. The first has been insurance, but short-term insurance of specific risks. And so, for instance, we invested in a travel insurance company earlier this year before the pandemic really started to become mainstream. And you'd think it's a bad investment, but actually, at least in the US, travel insurance is an afterthought. But when people start to travel, or they do have to travel, whether internationally or internationally, there's going to be a need, just given changes in regulations and restrictions, to purchase this, because an airline says they're going to refund their ticket, they may go bankrupt or may not uphold those obligations. So that's one area that we're still interested in, is looking at insurance that has come out of needs from the pandemic. The second area has been the modernization of core systems, especially for community banks. And, a lot of them, when they were processing PPP loans, for instance, were kind of caught with legacy systems that didn't meet the influx of demand that they had from existing and new potential customers. So that's the second area that we've been looking at specifically. And the third area has been really mobile payments and contactless payments, you name it. I mean, cash has become, well, it's always been dirty, but it's become more dirty because of, everything that's going on. Whether or not it can actually be transmitted through cash, I have no idea. Someone will have to fact check me on that. But, that's kind of something that's been already accelerated by COVID, and more people are setting up systems to accept credit card payments to the extent that that was a kind of less important part of their business. So for us as fintech investors, those are kind of three specific areas that I can point to that have seen that change, due to COVID and everything else. And these were already in the works, but now they've just come a little bit more quickly.
And I think, like, going back to your theme, kind of, Luke, it just seems like it's just an acceleration of things that we already knew needed to happen and were happening. It's like COVID just kind of kicked everything off of the cliff. Word of the day, acceleration. So, so getting to that, so how do you think this has sped up the need for innovation in other sectors? Kind of going back to that overall theme. Each sector that has seen this innovation, do we see this kind of going and spilling over into other sectors, forcing innovation?
I'll just note that, I think this is a tumultuous time, which creates lots of opportunities. So, a number of the companies that I work with are kind of pivoting and constantly trying to find the opportunity, which, in the past, maybe they pivoted every year, every couple of years, with some significant pivot in their model. But now it's more frequent pivoting because so many things are changing so quickly and everyone's trying to be the first to jump on top of that new opportunity. And it's really kind of across the board. So many things are changing right now. I do think there's lots of opportunities. One of the other things, with unemployment at these incredibly high rates, there's a lot of people out of work that are starting to innovate when they otherwise might not have had an equal amount of innovation at their, prior jobs. So I think that's also driving some new innovation across industry as people are trying to find ways to make it through this challenging time.
Yeah, I think one overlooked area, though, a lot of people, whether they're in college or, have kids in school, is education. And I think it's overlooked in terms of the need for innovation. I mean, a lot of colleges are still hosting classes on Zoom, and, I'm sure there's other solutions out there, but they haven't hit critical mass. And, I think going forward, regardless of whether school's open or not, there's been kind of an inherent desire for some people to create these kind of small micro schools, which are a combination of homeschooling, but you have 5 other students that are all, tested daily along with the teachers or whatnot. And so I think a combination of health tech, ed tech is something that's going to come and hasn't really been expected or talked about as much, even though they've been talked about separately as part of what's going on. And so that's kind of an area, obviously outside of fintech, that I think we'll see some interesting solutions. And then finally, if you're paying $40,000 to $60,000 to attend certain universities that will remain nameless that have gone online, is it worth it even to get a college degree? And I think it will potentially accelerate other organizations like Lambda School, et cetera, that are offering alternative forms of education. And so that's kind of another area that I think will just accelerate, going back to the cliched word that's been used a lot as part of COVID.
So just to throw in some quick validation for you there, Lucas, my past 3 calls were with ed tech companies, and I'm generally not an ed tech investor because, long sales cycle, bureaucratic sales process, ed tech, there's a lot of challenges in that category. But so much is changing right now that it's really creating a number of opportunities for companies to quickly scale to, the future of education. So just wanted to throw that in.
Well, I think it will remove the bureaucracy because a lot of people are going to take their children's education into their own hands. And so, it's going to go more B2C than B2B. And I agree with that, and, be interested to take closer looks at some of these, even if it's not my direct area of expertise.
And I think one of the differences is that previously a lot of these technologies would have been seen by universities, for example, looking at higher ed as a cost, and they're no longer looked at as a cost. They're looked at as essential technologies in order to continue to provide education and continue to retain students. So it's much easier for a lot of these solutions to show their value add and schools now have the budgets to basically spend money on these technologies, because otherwise, their students are going to drop off.
All right. So kind of digging deeper into these trends and innovation that we all should have an eye out for. What are some new and unexpected trends that you have seen emerge?
I'll comment on something. So we have certainly in the past we've certainly invested in kind of HR tech, but it hasn't been a huge focus for us. And I think I've certainly been surprised with the amount of new interesting companies that are getting demand in HR, in onboarding, kind of new employee experience. So from like an onboarding experience, an onboarding software, obviously it's like a weird time to hire, but companies are still hiring. It depends on kind of what industry you're in. You saw like Instacart, right? They hired like so many different people. But onboarding software is a place that we haven't spent a lot of time, that we've seen a lot of uptick. So in terms of onboarding, meaning like new employees that are joining your firm, ways to simulate, being in the office with the team and kind of meeting everyone and having coffee. That space, so onboarding, which falls into HR tech, we've seen a lot of demand for, which I think is super interesting. I think, yeah, so that's one place that we haven't traditionally spent a lot of time in, but we're starting to see uptick in there. And then also another space that we've traditionally not really liked as a firm, but now we're starting to see a lot of demand, is kind of knowledge management. So knowledge management in a traditional sense has always been this thing that has existed at large organizations. You can think of it as kind of like the intranet of when a large organization would have like an intranet, and it's always kind of been ignored in orgs. But now the demand for collaborative, like knowledge sharing databases, or a place where teams can store training materials, or store procedures, or store important documents, we've definitely seen an interesting interest from larger corporations and buyers of this type of software. So the two spaces have been kind of onboarding, HR tech, and the third being kind of knowledge management. Traditionally, things that we haven't spent a lot of time in and haven't been super excited about, but now they're getting more interesting. Just, as in effect of people just working in different places, people working remotely, and not everyone being in the same place.
Yeah, I'd say the most interesting idea I saw, and it was somewhat unexpected, but it makes sense, was a marketplace for virtual entertainment. So you think about, whatever icebreakers you do at company picnics or whatnot, but bringing that online and, having people do magic or, music videos to do team building, and you'd be able to book all of that virtually via Zoom. So I thought that was interesting and unexpected, although probably obvious, but overlooked. And so that's just one somewhat random example but to build on Erica's point about team building and team management and HR tech, still probably falls under that. And so that was pretty interesting to me, at least.
All right.
Oh,
go ahead.
I was just gonna say, I think my fellow panelists here hit the nail on the head. So what came to mind when you asked the question was engagement and retention software. Mm-hmm. So, we're seeing that in the ed tech space, we're seeing that in the HR space. What Lucas mentioned, engagement and retention is particularly important when you're remote. So we're seeing a lot of unique opportunities there.
Awesome. And so I want to make sure, because we got a lot of good questions coming in, that we leave plenty of time to answer some of them. And the one question kind of goes into our final segment that everyone has, everyone's rolling in, is what advice do you have for entrepreneurs and founders who are looking for a deal? That's the first question. Like, what advice do you have? Tips for pitching remotely, virtual models, things like that you think would really be helpful if they are trying to close a round right now in this climate? Some must-haves.
So I'd say and it gets overlooked. And some people say it's easier, some people say it's more difficult. I think it's more difficult is still have a human element to it. And, at least for us, when we're talking to investors after the first couple calls, we'll bring the dogs and kids if they have them in and actually do something like that. It's a lot easier, in my view, to get people to know them than in person, because we're all at home or somewhere relatively close to home. And I think that's important, is to actually have a human element of it. You don't want to be too casual, but you also don't want to be too formal and too rigid. And I think these types of solutions allow people to get to know each other a lot more quickly and a lot more personally. And so that's kind of my piece of advice. And then, a lot of people overlook even the, how's it going, and, discussing their various issues that they're dealing with working from home, even several months as well. And so talking about those is also important. So that's kind of an overarching thing that you don't put in the pitch, but it's just basic small talk and building rapport that I've seen gets overlooked about 80-90% of the time in terms of doing these meetings with entrepreneurs and other people.
So for us, when we think about, and I'm sure this is similar to my other panelists, but when you're when you're making a decision to invest in a company, it's very much a marriage, right? Like, you're going to be with the company 6, 8, 10 years. So when you can't actually sit with them at a coffee shop or have lunch or have breakfast or sit with them for a couple hours at a conference table going over a deal, going over the business, going over customers, you can try and do that over Zoom. So I've been doing, cooking classes and dinners, make your own food, with founders that we're in serious conversations with. So just getting that extra time and seeing what they're like outside of just like pitching to, having like a pitch session. So, and I've done, 7 feet apart social distance walks. Again, these are with founders, in COVID times that, have been willing to do that, but I'm still trying to spend as much time as I can with founders, again, that we're very much intending on giving a term sheet to. Maybe not the first meeting, right? The first, 1 hour meeting where you don't know if it's a match, but at the later stages, like, investing that time will definitely get you far. The investments that we've done through COVID, I was trying to think about like things that really stood out and got us to be excited, in addition to obviously the team and the product, but most of the companies had a A+ data room. So have a really, really good data room. Like, don't make the investor like guess and ask for materials, ask for the financials, ask for the projections. Like, having everything in that data room will save a lot of kind of back and forth. And I don't know if everyone knows what a data room is, but a data room is usually, on Dropbox or Box or whatnot. It has all the information about a company that you would need to diligence a deal. I know that companies that have done really well fundraising through COVID have had rock solid data rooms. There were no questions asked, full transparency. That really brought them far. I think another company that we wound up loving and working on for a deal during COVID, that we were surprised by them, was they had a deck about how their business was going to respond to COVID. So they actually put together like a 6-slide, it wasn't a huge deck, but a 6-slide deck of how their industry and their specific niche within an industry had responded and or actually had gone through and responded to previous recessions. It was very precise. It was very researched. It was based on economics. Again, this is a black swan event where you actually don't really know what's going to happen in a month. But the fact that they had thought about it and had the foresight to like predict the worst and have a plan to kind of prevent the worst gave us so much confidence in the team, right? And gave us so much confidence that they were aware and that they had done their research and they just shined. And we hadn't seen a team pitch that, but it was successful. So that's one thing that we were very surprised about, but that we loved that a team did. And it was in a final like kind of investment committee partnership presentation, and we were blown away.
So I love actionable takeaways. So let me just quickly throw out 4 that come to mind. First, if you're pitching during COVID, don't ignore the elephant in the room. You should be talking about COVID. Earlier during the pandemic, it was a question as to how you would address this in a pitch. Now, I think it's key that you talk about what your business was prior to COVID. how you pivoted, if at all, during COVID. What's your plan to survive COVID, and what's your plan for post-COVID? Second, which is related to my first point, be honest. Be very, very honest, right? So I got an investor update from one company that literally started out by saying, our revenue from our primary business line is currently $0. Bold, underline, started with the bad news. Fortunately, there was a then, however, we pivoted into this business model, and that revenue stream is scaling much faster than our primary business. So, fortunately, there was good news there. But even if there wasn't good news there, you get a lot of points by being honest and upfront with your investors. Transparency is key. I'm much happier to write a follow-on check into a company if I see the need for that follow-on check way in advance and understand why we get there. For the company that says we're doing great, revenue is scaling, everything's wonderful, and then they say we're out of money, I'm much less inclined to invest in that company because I'm concerned about the transparency. 3, I'll say know your tech. This seems obvious, but you wouldn't believe how many people pitch and have huge tech issues, and it's that much more apparent now that everything is remote. But when you're talking to the CEO of a communication technology company and you can't figure out how to get Zoom to work, that's a really bad sign. And fourth and finally, I'll just say don't lose hope. Raising capital is never easy. It's more challenging now, but deals are getting done and there's opportunities out there. So just, we're looking for grittiness and, stick with it.
Yeah, and the last 2 points I think that are different than meeting in person or even having a phone call is when you do these Zoom calls initially, actually it helps to have the deck and be able to point to it. I don't like to go slide by slide through an investor deck, but it's helpful to point to it because it's right here and it creates a little more focus than a casual coffee conversation. I mean, a Zoom is still obviously pretty casual. And the second thing is, be ready to show the tech, because all you have to do is push a button and you can show the website. And if you're not prepared to walk through it, or, some people say they need their CTO or whatever, to Benjamin's point, it's, not a good look, and you should be able to own the fact that, you can show people what you're working on a lot more easily than obviously on the phone. And, even in a coffee shop or an office, it requires more setup and more time. And so here you actually have an advantage if you're really proud of something you're building with. I even respect when people want to jump into that immediately and say, hey, let me show you, and abandon the deck, and we go straight into the nitty gritty of what they're building and why, even if it doesn't look perfect. So that's another piece of advice, is be ready to kind of adapt and move to different types of circumstances, even over Zoom.
That's really, really solid advice. So moving into the Q&A section, I see a couple people have asked if you all can give a little bit more specifics on the types of things you're looking for in companies. I think Erica had mentioned the team before, and I know that varies across the type of technology and the types of things. So if you guys can keep it as high level as possible, but giving high level and specific at the same time, because we have a couple of different founders from different industries, and I know that kind of varies. So what are the things that you all are looking for when you look at companies and their founders?
Yeah, so I can talk, team, you had mentioned mine. Team is the most important thing for CRV. So then what does that mean? I'll dig into that. One thing that we look for a lot in teams, and we have different practices, right? We have biotech, we have healthcare, we have consumer, we have enterprise. I'm enterprise, so I'm biased towards kind of B2B. But when we look at a founding team and we look at, the CEO, COO, like CTO, the team that built the business, we really look for, have they, in every decision that they've made, or every kind of career shift that they've made, or whatnot, have they kind of shown excellence in every decision that they made? And it could be, it could be a failed company, but did they pivot back really quickly? Did they, if they had a product that, didn't do well, did they pivot into something else? Showing strong decision making and smart decision making at every pivot of their life, and kind of, exuberating kind of excellence is what we look for. Other things that we love. So we love teams that have built stuff before. So they built product before? Have they built teams before? Have they built businesses before? We look for founder market fit. So that's very important to us. Founder market fit being, okay, like, you know, if they're starting a company in the telehealth space, like, have they worked in, you know, the medical space before? Like, is healthcare something that you can clearly see in their career trajectory that they've valued? You know, that's an example, like with healthcare, but founder market fit. So like, does it make sense that they're in this industry? And then the last thing that we certainly look for is, can we really identify why the founder is building this business? What is the reason? We really like poke at that. What is the real reason why they're going to work on this for the next 6 to 8 to 10 years? It could be a family related thing. It could be, you know, a personal, you know, but there needs to be a reason why they're going to commit to this for the next, you know, 6, 8, 10 years. Because venture is not a 1 to 2 year thing. Like that is not the game that we're in. That's not how the venture model works. So that's the last thing, like really poking at why they're building this business, and having a good explanation. Half of the time it's BS, but like if you just like, if you can have a good story like that, the story is what we certainly look for a lot.
So I'll just say, so I generally say I invest in seed stage tech companies based on the East Coast. So when I say seed stage, I'm looking at companies that have fully fleshed out teams, 1 or more products in market, and some significant amount of traction. I invest in a range of different tech companies. So if if somebody says, well, I'm not a tech company, but I'm tech enabled, that might be outside my sweet spot. But if you're a technology company attacking a certain sector with a technology solution, it's the type of company I would talk to. I look at companies kind of across the East Coast. By East Coast, I mean not West Coast. I've had people try to convince me that Silicon Valley should be included in my East Coast thesis. That's too far. Most of my deals are mid-Atlantic, which I define as Boston to DC, Pittsburgh to the ocean. And let me just say that, you know, when I'm looking at teams, what I'm looking for is not a sole founder, right? A team, meaning more than one founder, a group of people that have complementary skill sets and also that are diverse from one another. So what diversity means and what's important kind of depends on the company, but basically looking for lots of different types of diversity. I mean, a majority of my portfolio companies are female or minority led, but that's not necessarily a requirement. But it's not just that, it's, you know, diversity of experience, diversity of education, geography, you know, and it also relates to your product. So for example, a couple of months ago, I was looking at a company that had a product that is only sold to women. It's a female product. And their team, not only was their CEO a male, but on the slide of the team, there were 6 other males. So he had a 7-person founder team of 7 men selling a product solely to women, which I thought probably isn't an appropriately diverse team if that's going to be the market that they're attacking.
And for us, we're seed stage focused on fintech and insurtech with B2B or B2B2C models primarily, outside of Silicon Valley as well, but extra bonus points if you're in between the coasts and spend a lot of time in Atlanta and the Midwest as well. In terms of what we're looking for on the fintech side, you know, I mean, every industry has their own regulations, but for fintech, a lot of things have been tried and don't work because there's regulations related to it, especially in payments, lending, and insurance, where we spend a lot of our time. So really understanding your product can work within a regulatory framework, a lot of people have overlooked. The second thing is a true assessment of the competition. To say you have no competition at this point in fintech, I haven't seen many companies that truly have no direct competition. And so trying to assess your competitive landscape is important. And then third is really the passion. I mean, honestly, if someone says, I want to make a lot of money on this company, I say, great, but you're not for us. It's really the passion and the ability to stick with it for 10 years, because it's not going to be easy. And realistically speaking, most ventures fail or return 1x the money put into it, and it's not always a great outcome. So there's got to be some reason to do it, outside of the financial return as well. And so those are kind of what we're looking for specifically when we approach our investments.
All right. And kind of going off of that, is revenue the most important factor for a firm to invest in a startup? I mean, we're all early stage here, so I think that's a different, I'd love to hear Ben. He immediately said no. So
Yeah, so short answer is no, but we are looking to de-risk our investments, right? So we're looking for market validation. So revenue is a great way to show market validation, right? So if you have your product in market and people are buying it for a high price point with a nice margin, that's great validation that there's a market for your product and a great validation of a number of other elements that we're looking for. So revenue is great, but that's not the only thing we're looking for, and that's not the primary thing we're looking for. I would much rather see a great team with a great model and 5 million downloads rather than 500,000 in revenue, right? So if they could connect what they have to revenue, that's important. If you have a bunch of traction but don't have a model to monetize it, that's not interesting. But I would much rather have a company with a lot of non-revenue traction and a plan to monetize it versus a company with a medium amount of revenue.
Yeah, and I'd say it's important too that if you have a plan to revenues, but getting the first dollar of revenue in the door without funding is the plan I actually like to see. A lot of people say I need funding to get to my first revenue, and I say I don't think that's the case. I mean, any sort of company within fintech that I've seen can get $1 of revenue without any external funding, and even if the founder doesn't have much to put in the company themselves. And so I think that's a very important nuance that's overlooked, is a lot of people think they need money to hire salespeople to go out, but usually the CEOs, even if they're not great salespeople, are the best salespeople starting off because they know their product's the best. And so really focusing on the path to revenues without investment is one important thing. The second thing I think is really finding people that share the same view of the world as you, and you might take a call or two to figure that out. But trying to convince people with a different world view than you, I think is actually really difficult to come into as a founder. And, I think it's a really tough sell. So finding people that see the world in a similar manner to you, and it doesn't have to be, I believe in diversity of opinions and thoughts, but, most people, regardless of their backgrounds, can come to some sort of agreement, but trying to convince someone that has a completely different opinion than you, especially when you're raising money, is really difficult to do. So finding people that share your same views is important, and it's mainly a view of the world and a view of your product specifically, not necessarily other external factors, is what I'm trying to say.
Yeah, and I'll add, so I think the importance of revenue very much comes with stage, right? So I'm focused on early stage, but we certainly do growth as well. At the growth stages, 100% traction. Revenue is not the most important thing, but traction, revenue, market is super important. When you're raising 50, 60, 70, $100 million, you can't have frou revenue, right? That's when actually it becomes more of a PE-ish exercise, modeling out financials. You might have debt. Growth, of course, it's very important. Early stage, I would say it's a balance between three things, and they kind of correct each other. So market, product, team. So you saw, especially in COVID, there were so many companies that had barely any revenue, but the market was hot, like tools for distributed teams or collaboration tools, and they raised ginormous rounds. That was a scenario where the market was so hot, so it lessened the need for revenue, lessened the need for traction. I think we at CRV, because we value teams so much, many times if we back a repeat team or back one of our CEOs that already sold multiple businesses before, do they need revenue? No, because the team is already such a good team, so it kind of balances out or kind of cancels out the need for significant revenue at a seed or significant revenue at the A. I think in the end, it's all a balance between market, product, team, and kind of traction. And when one weighs a little bit more than the other, you can give a little on the other end. Because in the end, an investment decision is such a specific, and deciding to invest in a company is such a specific and intimate decision, right? So it's not just check the box and kind of certain things that people need to do. You kind of balance it out, and I think it's very much weighing out the different things that determine the value of revenue in an early stage investment.
For sure. And I think Erica, because to that point, like I said, most of us here are in the early stage space. And I think you hit that nail right on the head with the 3 points that you just mentioned. So this one I think is a really interesting question, knowing because I had a conversation earlier with one of our founders who they're in the European market. And so as the US economy and US businesses struggle with COVID, what is your take on international companies looking to enter the US market and search for investors? Like, what advice do you have for them?
So for us, we've certainly been making a lot of investments. We've always had a bunch of companies in Israel. We have a company in India, and we've been certainly exploring the European markets a lot more. And I think we've certainly seen with our own portfolio companies that the US is certainly not recovering as well as Asia, as Europe. So investors still have the capital that they raised, right? Like we all raised, there was a lot of capital that was raised in the last couple of years. And I certainly feel like there's more of a willingness to invest abroad, especially now because the markets are recovering. Now I've been spending a lot of my time with companies in Europe recently, just because the companies have bounced back, especially in like mobility and transportation, spaces that I actually spend a lot of time with. I've certainly, a lot of my time, more than ever, has been spent with companies out of the US. Again, US is our focus, obviously, but you know, I think it's a really good time for strong international companies to be tapping into kind of the US VC network, because these companies are doing, lots of companies outside the US are doing well.
Well, I think it's having an updated plan on sales and distribution for expanding in the US, because you know, travel, at least from the US to Europe, has been shut down, and you know, there's other considerations at play for immigration right now. And so having a true strategy and where you're going to locate and why in the US and establishing a footprint here is important. I think it's very difficult to sell new products specifically virtually, and you need people, even if they're doing, you know, Zoom meetings or combination of face-to-face, you need to establish a team and have a good network within there. And there's a lot of funds now that are helping, you know, Israeli US entrepreneurs, for instance, Asian, you know, US companies develop footprints in each landscape. And so finding investors that have experience doing this, I think, is more important now than ever. And they can help you find teams and distribution strategies within the US to go about it. But I think it's going to be very difficult to sell virtually, and you need to establish some sort of footprint physically in the US to do so, you know, by hiring or whatnot.
All right. Well, okay, go ahead, Ben.
I'm happy to defer to my colleagues here. I think getting advice is really cheap and easy. Getting good advice is much harder and more expensive, and the trick is to ask the right person for the advice. Given that I don't do any investment in non-US based companies, I'll defer to these guys.
Got it. And so with that, I'd love if everybody could kind of share any parting advice that they have for all of our founders, and then we can wrap up. So any parting notes?
I mean, I would say more so than March, I'm cautiously optimistic, and you know, I think things will slowly get back to some form of normal. And you know, it's really taking advantage of the time now to schedule more meetings with investors virtually, and then follow up in person when it's acceptable to do so, or you know, that's still a criteria for a lot of investors. And so taking time now to kind of broaden your network is important. And you know, I think that we do start to see some sort of normalcy in the fall, and then definitely when a vaccine is fully ready, I think we can start to do what we've been used to in minimizing meetings probably, but you know, still be important to meet founders that we invest in. And I think that's something that, you know, we really have to wait and see on. So be cautiously optimistic and wait and see, but in my view, things will get better and return to normal, at least on the VC landscape side.
Just a quick thought. So I had lunch with a federal judge a number of years back, and he told me something that stuck with me. He said, you know, the key to success is finding the line between being persistent and being annoying, and then pushing that line. So I think about that a lot. You know, outside of COVID, I would meet with a lot of entrepreneurs daily for lunches and dinners and drinks. And, you know, it's easy to get my full attention when we each have a beer and are sitting at a 2-person table. Outside of that, when I get thousands of messages via dozens of apps on my phone, it's a little bit harder to get my attention. But I would say be persistent and also figure out a way to stand out. So that's my parting shot.
And for me, you know, one thing that I think is I've always thought about it, and we tell kind of our founders, is that true leadership is never shown at the best times. It's always shown at the worst. So everyone is going through this, right? Like everyone is going through change. Everyone needs to be flexible. I think advice in terms of like good things that all kind of teams should be doing is talk to your customers, like look at your data, focus on customer support, customer experience, think about retention, and really, you know, treat your employees well, like foster the team, like make sure, you know, your stars or star salesperson, you know, your stars, whatnot, like make sure that, you know, they're taken care of because they'll stick with you. And again, like back to the team, like make sure to take care of your team, take care of yourself. Burnout is a real thing. But yeah, those are kind of things that we've been having as our mantra for our company.
And on that, I think we should end it there, because I think burnout is a real thing for everyone on this call. So make sure you're taking care of yourselves and your teams. And so I'll hand it back over to the Tech and Motion team so that if they have any things they need to say before we close, we can kind of move on with the rest of our day.
Terrific. Thanks so much, Anastasia. I really want to extend a huge thank you to all of you for those insights and takeaways and for offering up your time and expertise today. In case any of you missed any parts of today's conversation, we will be making a recording of the webinar available on our YouTube channel. And real quick, one last thing I want to note at the beginning of today's webinar, I promised all of you an exciting announcement for our viewers. And I'm really excited to announce that our 2020 Timmy Awards are back in a way that you've never really experienced before. This year's program is going to be very special, entirely a digital experience, honoring this year's best tech startups, managers, employers, as well as those who are using technology right now to help alleviate and address the impact of COVID-19. And as many of you are in our audience today are entrepreneurs, founders, and startups yourselves. Following today's webinar this afternoon, you'll actually be receiving a sneak peek into this year's awards program with more information on how to nominate as soon as next week. So definitely keep an eye out for that email. Thank you again so much to all of our speakers today. What an incredible conversation. And we look forward to staying connected with all of you through future events and programs. Thanks, everybody. Have a great day.
Thank you.
Thanks, guys. Take care.